Welcome back. Continuing our conversation on the markets with Maneesh Dangi from Mosaic Asset Management now, who is joining in. Manish, good morning. Thank you for joining in. And the big global question now is whether or not the Fed cuts rates next month. The general consensus among a lot of the Fed members who have spoken all through the week and the week before that has been that it will be prudent to keep rates on hold next month. But based on the macros that are emerging with the lack of data and the data fog that the Fed's facing, what do you expect the Fed to do this time around next month?
Hi, morning. So the probability of rate cut, of course, given that US is a very transparent system, and now we know, as a matter of fact, that the probability is less than 50. Markets sort of are actually poised to think through this particular event, and I kind of think that for next 6-12 months, markets are pricing in about 50 basis point. My personal view, of course, is that underneath this AI boom, there is sort of a slowdown developing in the US, and that should pave way for deeper rate cuts over the next 6-12 months. But the base case, of course, market expectation is that 50 basis point rate cut coming in 2026.
Maneesh, hi, morning. What about RBI? You have said the RBI has no choice. Rates have to get crushed much lower. Tell us a little bit more about this.
Yeah. It's to get your attention there. The crush lower, essentially, markets are baking in about 50 basis point rate cut. India sort of has a decent macro. For a very long time, we really didn't have the place to actually ease rates as dramatically as we can today. And most importantly, as a matter of fact, Indian nominal GDP growth is beginning to converge with the nominal government bond yields. That's not what you and I have seen over the last 25, 30 years. Until about a decade ago, the nominal GDP growth used to be 6, 7, 8% higher than the bond yield. They pretty much are converging right now. And I think, think of it from an equity market partner's standpoint, the nominal GDP growth, which is 7, 8% right now, is like ROE of a country. And the bond yields are like a cost of capital for the country. And, if they converge, of course, they should hit hard in terms of investment intentions or PE ratios, the way you see it. So my sense is that India has a decent playground now to actually ease rates significantly, not from a cyclical standpoint, but actually ease rates in a meaningful fashion that they're actually lower than what we've seen in the previous cycles.
So what are the numbers we're looking at? Not just in the near term, but as you said, this is a structural thing now. Rates over the long term in India have to be much lower.
Yes. I think, because Indian inflation has converged with the West to a certain extent, and a lot of Chinese deflation is entering our geography. Indian dependency rates have now come into this real, demographic dividend era. Our CAD has actually now sort of ex-gold is tracking 0.5% or thereabout. So we have all, potential conditions to actually beginning to converge over next 10, 15 years with, what perhaps you have in China. Our total fertility rate is also likely to converge with China in next 20, 25 years. So I think over a longer period of time, all rates almost all the time, converge. And I guess, something would happen to Indian bond markets also. So my sense is that I won't be surprised if the central tendency of bond yields, which is right now at 7%, will go to 4% in 10, 15 years' time. But these are very long-run views. In this cycle, as I've argued on your channel for the last 1.5 years, I see bonds at 5.5 or below on a 10-year bond yield, I mean.
And this inflation in India, what are the numbers we should expect over the next 12 months?
So super low inflation, ex-gold inflation actually is sort of sub to core inflation. I think it will, given now there's a super low base rate now, especially on the food side, some buoyancy will be there in inflation, so this low inflation actually not good for markets. So hopefully with GST cuts, maybe sort of substantial more rate easing, more liquidity, some kind of pickup in inflation should happen over next 12 months. But I wouldn't be betting on inflation more than 4.5% over next 1 year also. So in a sense, yeah, so again, base case is to be close to 4, what RBI wants to achieve. And therefore, the base case is that the repo rate should be 5 or below in 6-12 months' time.
Maneesh, thank you so much for sparing time and joining us. Running out of time, so we'll continue this conversation when we have you next on the platform. Take a short break. On the other side, our big story. Rituraj Sinha from SIS and Sonu Iyer from EY India join in to discuss the impact of the new labour laws. Stay tuned.